Welcome to our program here today. My name is Sarah Morgan, and I'm one of the practice group leaders of the M&A and Capital Markets Group at BNE, and we are very excited about our program for you today. We're excited today to be providing you with an overview of financing structural alternatives for private capital raises, as well as walking through some of the key issues to consider and market trends and financing terms, with a particular focus on the energy transition. While the public markets have been a little bit choppy this year due to all the broader macro reasons, we are continuing to see a robust flow of private capital raises. And this is even more true for companies that are in the energy transition, which is our focus today, as the Inflation Reduction Act has provided significant incentives and opportunities for future growth for those industries. And just to put a plug in for our energy transition team and our tax team, we've been doing a ton of work on the IRA and have a lot of materials that do deep dives into each industry vertical. So if anyone has questions about that, shoot me an email. We're happy to share any materials and answer any questions about that as well. But coming back to our panel today, we're very excited about the panel for the diversity of views that it represents. You're going to be getting the investor views, the investment banker views, as well as the legal perspectives on private capital. From the investment banking side, we have Courtney McBean, who's the Senior Managing Director in Evercore's Menlo Park-based technology group. She works on strategic and financing transactions for many leading technology clients. And before joining Evercore, she was a Managing Director at Greenhill focused on technology clients. Prior to that, she was a VP in Citi's Global Technology Investment Banking Group. So a lot of experience with private capital raises for technology companies. And then she started her career as a corporate and M&A lawyer at Wilson Sonsini. From the investor perspective, we have our client, Laurel Buckner, a managing director of Riverstone. She's based on the West Coast, but she splits her time between Menlo Park and New York. And throughout her career, both as an investor and an operator, she's focused on innovative technologies disrupting traditional businesses. Prior to joining Riverstone, she was managing director at West River Group and the co-head of the firm's Pacific Northwest Fund, investing in technology solutions. Prior to WRG, she was an SVP at ATN Ventures, investing in novel technologies. And prior to ATN, she ran GCI's corporate venture fund. And then in a continuing trend of people who started out in the law and left for business, she started her career at the law firm of Davis Wright Tremaine, as a corporate lawyer in tax and M&A. And then last but not least, I'd like to introduce my colleague and partner, Michael Gibson, who's out of our Austin office, but with you guys in New York today. And he advises clients on strategic and capital raising transactions and has significant experience with preferred stock, equity financings, convertible debt financings, minority and growth investments, and corporate reorganizations. And I'm going to brag on him because he won't do it himself, but he's just the best. He's the best at executing and getting things done and giving really practical advice when it comes to private capital raises, M&A transactions, and the like. So you are in very good hands today with all three of these guys, and I'm going to turn it over to them. Thank you.
Thank you, Sarah, for the great introduction. You have one lawyer and two recovering lawyers here, so hopefully we can get you all some good info today. Wanted to start with this slide, which I think really captures what we have all seen in the market and in the energy transition. This is some data that Bloomberg pulled over the growth in all investment. This is not just private investment, but the growth in all investment in the energy transition separated out by industry sector over the last 15 years or so. So you see, hundreds of billions of dollars a year. The data on the right is also super interesting. This is some estimates by a couple of banks and the IEA of the amount of new capital that's going to need to be deployed in the energy transition over the next 30 years or so. And if you do the math, even based on the lowest estimate here, we're talking about 5 times the amount of capital as the highest year in here, 2021. So we're very bullish on the energy transition and what's going on there, both from a technology perspective and from a capital deployment perspective. I think that the data backs that up. Wanted to spend some time today giving you all an overview of how is this capital being raised in the private markets? What are the structures that are being used? What are the considerations that folks are thinking through as they're structuring these deals or as they're negotiating them from a legal perspective and obviously from an investor and a deal facilitator perspective. When we're talking about private capital raises, we're obviously talking about the private market, not the public markets. You could, and companies do, go raise money in the public markets all the time. These raises aren't happening in the public market for various reasons. One of them is a lot of these companies are much too early stage, SPAC transactions notwithstanding, to access the public markets. And so, we're talking about developing companies, early stage companies, all the way up through pre-IPO companies that are still working to hit their benchmarks for growth, benchmarks for revenue, all of those things. And the way that they are raising capital is in the private markets. So Laura, one question for you. So this chart, which is showing deal activity over the last year, and then the prior chart over the last 15 years, I think it resonates with me, at least for what I've seen in the market, but curious what your perspective is on where the market is now and where we might be heading.
Yeah, it's been a very busy time for investors. There's no shortage of companies that are looking for capital right now. And I think what's interesting about the energy transition in particular is that a lot of early stage, some of growth investors, Series B and onward, looking to scale, help companies scale, as opposed to taking a lot of technology risk. And I would say there are companies that I've been seeing that are pretty mature, actually, when they're coming now to either A, B, or C. They were maybe spun out of a university 10 years ago with a PhD thesis, and they've been working on something for a while. So that's, I see this in, obviously up and to the right with respect to the amount of capital that's being raised and I think deployed in this area. But these are not new companies. I think it's just they're more mature and the time is right for investment. So this also resonated with me. I think it's probably the busiest summer as an investor in terms of the amount of companies that I've ever seen out raising capital.
And Courtney, obviously, we've been in a really, really strong company-friendly market with maybe a few months of blip during COVID for what feels like a long time. What are you seeing in the market right now?
No doubt the market has become more challenging, really started in late spring and accelerated through the summer. And like many market dislocations, the private markets lagged the public markets. But by June, the private markets really had caught up to the public markets, and in particular in valuation and public market comps. We're clearly in more of an investor-friendly environment. As Laurel said, investors are looking at a lot of opportunities as companies have delayed their public offering plans. And investors are being very discriminate in the opportunities that they evaluate. That all said, energy transition continues to be one of, if not the most active sectors. A record number of funds and capital have been raised to address climate change, massive government funding in the Infrastructure Investment and Jobs Act and the IRA, significant state level regulations, in particular coming out of California. And really the fundamental industry drivers for energy transition not only are intact, but really have accelerated as the market dislocation has increased. So we're still seeing a lot of activity in energy transition. It's just really shifted from, as you said, a company-friendly environment to more of an investor-friendly environment.
So moving into an overview of what I mean by what are the alternatives in financing these or in structuring these financings. So I think this is a useful little graphic that shows how what I consider to be the 5 main categories of ways that you can raise private capital, moving from common equity on the left to structures that get less and less like common equity as you move further right. Some key things here to focus on. One is the cost of capital that varies as you go from left to right. So obviously common equity, highest cost of capital. If you think about cost of capital as how much do the existing equity owners of the business have to give up to get the money in the door. And then moving all the way to the right, debt with maybe some warrant coverage, lower cost of capital, assuming that this is a business that continues to grow and get more valuable. But obviously, if that isn't the case, then you may be able to sell common equity for nothing because you don't have to pay them at the end of the day. So, price is obviously one huge consideration. You can get debt for a relatively lower cost of capital. Common equity is more expensive in those terms. Seniority is another key consideration. So where do you, as an investor, if you're holding one of these securities, where do you sit in the capital stack? If there's a liquidation event or the company gets sold, do you get your money out first? Second, are you last in line? And that sort of goes from debt at the top of the stack all the way down to common equity at the bottom. Another consideration is, are you putting a definite value or at least a mark on the common equity of the company that you're investing in? So if you're buying common equity, then obviously you're putting a mark, you're paying a price per share. That's what the company and the investor agree is the fair market value. Moving over to the right, debt and warrants, there may not be any sort of a mark to common equity in that transaction at all. Maybe there's an exercise price on the warrant, so it gets close, but there may not even be that. Another thing to consider is whether there's a current cash payment. Debt and warrants, again, the far right of the graphic here, typically that's going to have some sort of a cash pay component on a recurring basis. Common equity in a private company almost never has a cash pay component. These growing companies aren't paying dividends, and no one's expecting them to. Maturity date is another key thing to keep in mind at the outset. Is there some sort of a fixed timeline on which the company has to repay this capital? Again, debt will have a maturity date. There will be a marker out there, or the company knows it's going to need to go get that capital refinanced, or it's going to need to pay it back. And then common equity, obviously, no maturity date. Last point to think about is at the outset is what sort of governance and control rights are you going to get if you invest in these securities? So common equity, by more market convention than any real requirement, if you're investing in common, you're not typically going to get a suite of governance protections. Maybe you will, but less common. Convertible preferred, we'll talk about this more later. You're almost always going to get at least a baseline level of minority protections, maybe a board seat, maybe some information rights. And then you move on to debt and warrants, and you're likely going to have you will have some significant operational covenants, but you may not have some of the other things that a minority equity investor would have. Courtney, for you on this one, other than valuation, which obviously is driving the economics on these deals, where do you see the most friction between companies and investors?
Yeah, after valuation, which is probably the highest amount of friction between companies and investors, I would say it's governance. To your earlier point, whether it's board seats, information rights, protections from a governance perspective is one of the biggest focused areas. After that, it's also, liquidation preference is an important consideration, obviously depending on the instrument. And then you have other provisions like anti-dilution provisions and redemption rights that I would put a little bit further below, but are also issues that need to be negotiated.
And Laurel, so from your perspective as an investor, again, setting aside valuation, what are you typically most focused on?
Yeah, I think governance definitely, but really the structure of the equity and how those terms are changing at any given time, which is why I always like to consult with my lawyer, who's constantly doing a lot of these deals. I'm not the only client, so they've got their finger on the pulse of the market, which I find to be really helpful, because actually setting price and terms are part of what the market's going to bear. And if you're working with someone who has a good sense of what the market is bearing for a certain type of transaction, that can be really informative about how you're going to be able to negotiate. So certainly, the structure around what's the feature of the equity? How much is it one-time liquidation preference? Is it a two-time liquidation preference? I know you're going to talk a little bit more about preferred, but I think there can be features of the actual equity that's being offered that could be negotiated that are friendly to the investor, friendly to the company, depending on who, sort of has the benefit of the negotiation power at any given moment. And that's really dependent on the market conditions and what those willing buyer and willing sellers are willing to come to an agreement on. So again, sort of getting the taste of the market from what the lawyer is saying, and then seeing where I can craft risk or protection to ensure that I'm issuing or getting a security that has the appropriate amount of risk with the underlying asset that I'm investing in.
But so the first structure we're going to talk through, and I guess to preview, I'm going to walk left to right on this chart. So from most common equity like to least common equity like, and discuss in a little bit more detail each of these structures. So for common equity, this is equity in its simplest form. If you think about, the difference between equity and debt, equity gives you the entitlement to share in the residual value of a company after everybody senior to you has been repaid, and that includes, that includes not just actual creditors, but it includes vendors that you may owe money. It includes employees and all those folks. So equity is behind everybody from a return perspective. And what you're typically buying when you're buying common equity is the right to share in a percentage of that residual value. This is an uncommon structure for these investments. I wanted to include it because you do see folks investing in common equity, especially as things get more mature. And obviously, if you're investing in the public markets, a lot of times, most frequently, you're buying common equity. So it is an instrument that folks are familiar with, but you really don't see it much in our transactions. And I would say that's mostly because you don't have any sort of downside protection, and that's a feature that all these other structures give you. So let's see if I've got my slides back here. Excellent. So this is just a little bit of an overview of how would an issuer think about a common equity raise, and how would an investor think about this? What is the common equity raise giving each side? For the issuer, one great element of doing a common raise is everybody's returns are aligned. If the investor makes money, the existing owners make money, assuming they own common. Nobody's sort of protecting a certain valuation range where they've got either a special return profile, or they get money when common doesn't. These are also relatively simple. Again, that's more by market convention than because they need to be. But you don't need to fight about special rights of the security because it doesn't have any. Anything you may be adding would be contractual and not in the governing documents of the company. Typically, no fixed repayment obligation. This equity can sit out as long as the company wants it to. There's no timeline for return, but super high cost of capital if your business continues to grow and get more valuable at the end of the life cycle of your company. You may look back and look at how much of the return was captured by the investor and think that was ultimately not a great deal. From the investor's perspective, again, sort of the flip side, all the upside is there, but obviously, like I said, no downside protection. So the risk that your invested capital is going to go to zero is at the highest in this structure. You don't have any sort of seniority. You also don't know how you're going to get your money out of this company. You have a few options for getting a return on equity. One is dividends, and as I mentioned, these private companies aren't paying dividends. You also could get cashed out in a sale transaction, but as a common equity holder, you don't drive the bus on that, so to speak. You're going to be dependent on other equity holders and the board to make those decisions. And so all of that liquidity risk is out there. Also, you'll typically have fewer governance protections than you would in a convertible preferred. So I talked about path to liquidity. It's something you've really got to be focused on here, where you don't have the ability to drive a sale transaction. Obviously, one thing that you do control, absent some contractual prohibition, is being able to sell out of your position to a third party and subject to securities law considerations. But the market isn't nearly as well developed as a public market. So you've got to find a buyer. There's going to be some discounting involved typically because you're asking them to jump into a private security. There's also no downside protection. So if we're talking about a company that isn't hitting their metrics or isn't going up into the right from a valuation perspective, it may be tough to get somebody to buy in at a price you're willing to sell at. One last thing to talk about on common equity is that the cost of capital consideration that I talked about, that obviously changes as the company gets more mature and de-risked. As it becomes more apparent that there's a viable business there, you may be able to raise common equity much cheaper than you would if you were a angel stage startup with really nothing more than an idea. So moving on to convertible preferred equity. This is the most common structure that I see in the market for these deals. And we'll talk about some reasons why that may be the case. Think about convertible preferred equity as having all of the features of common equity, but with a preference on liquidation. So there's two, and just to break down the term to sort of orient everybody. When we talk about convertible preferred equity, the convertible means it's convertible into common stock. Typically, that's at a 1-to-1 ratio. So if you hold 1 share of preferred, you can convert it to 1 share of common. And then whatever price you paid for the preferred is the mark, so to speak, on the value of common at that time, with some caveats. So that's what we mean by convertible. The preferred piece is talking about the bundle of preferences that these shares have over common equity, with the most important one of those preferences being a liquidation preference, which we've talked about a few times. But that liquidation preference entitles you to most typically 1x your capital amount back before the common equity gets to participate in any sort of proceeds. So if I bought into a company, paid $10 million, at a $40 million valuation, before the common gets anything, I get my $10 million back. So if the company doesn't perform well and ultimately it sells for $15 million, I get my $10 million back and common gets to split the 5. So a very powerful feature for an investor when you're thinking about investing into a growing company with a lot of risk is the ability to get your money out first. So that's liquidation preference. On conversion, I mentioned that the conversion ratio is typically 1-to-1 initially. So you're buying a share of common stock, but you have all these, economically, you're buying a share of common stock, but you have a bunch of protections around it. That conversion price can change over time if you have anti-dilution protection. Anti-dilution protection can be one of the more challenging things to think about in these deals, one of the features that's hardest to try to get your arms around. But the easiest way, I think, to think about it is if somebody else comes into this company and buys shares at a lower valuation than the valuation that my price was based on, then I've just been economically diluted. The value of what I hold is now lower than I thought it was. And so I'm going to want some protection on that, or at least that's how the market is developed, is that investors in these deals get some protection on that. One type of protection you can have, and this is the most common, by far the most common, it's called weighted average anti-dilution. And what that essentially does, a complicated formula. If you ever look at a certificate of incorporation of one of these companies, the formula is built out in explicit detail. But what this formula does is it compares the price that I paid at the higher round, so the higher price, and how much money I put in against the lower price that the new investor paid and how much money they put in. And it doesn't give me a full economic adjustment to the lower price, but using that ratio, it gives me some adjustment so that my upside value in the company is slightly increased to the 1-to-1 conversion ratio. The less common approach to this and much more powerful for an investor is called full ratchet anti-dilution protection. So this is where if somebody comes in at a lower price in the future, my conversion price gets adjusted just to that new lower price. So from an upside perspective, it's as if I put in all of my money at that lower price, which if you do the math, means that you as an investor are entitled to more of the company on a fully diluted basis than you otherwise would be. Super powerful feature. Don't see it all the time, although we'll talk at the very end if we have time about whether we're seeing more of that in this market. Another important element of this convertible preferred equity is that it is not only convertible at the investor's option, which it always is, it also automatically converts to common stock on certain events. The company wants this to happen because if in many structures, if the preferred doesn't convert to common, then there's sort of a de facto block right on the transaction happening like an IPO. You're not going to list a common security and also have a 1x preferred sitting on top of it in the capital structure. You could do it, but the market will tell you shouldn't. And so these preferreds will automatically convert into common at an IPO, but with some protections built in. And those protections are typically some minimum price that the company has to be listing at to make sure that the liquidation preference is being respected. If you're an investor who paid $10 a share, you wouldn't want a company to IPO without your consent at $5 a share, because by IPOing, they're going to get rid of your liquidation preference. So there's typically a minimum price component. There's also typically a minimum capital raise component, although this doesn't have to be a very big dollar amount. It can be something as low as $50 million. Sometimes you see 100. The point of that is really just to make sure that it's a real capital raise and not something that is being done just to convert the preferred to common. You'll also see other events being given this automatic conversion treatment. The most common other event would be the vote of some group of the preferred. Typically, that would be a majority of the preferred. This just gives the company and the investor base the flexibility to change the capital structure if they need to down the road without every single preferred investor having an individual block right. Another set of transactions where there may be an automatic conversion is on a de-SPAC transaction or a direct listing transaction. And so when I say de-SPAC, I mean a combination of this company with a SPAC, which results in that combined company being publicly listed. And then direct listing is listing the shares of the company on a public exchange without going through a typical underwritten IPO. So direct listing, you may have heard Spotify did it. A few other companies have did it. Less common, but does happen. If you don't provide for automatic conversion on these events, then you got to review the documents. But typically, what that means is that the preferred has a de facto block right on those deals. And so, what we were seeing a lot in the market over the last couple of years is folks being focused on avoiding that block right unless it was specifically negotiated. And so you can build in provisions that put some minimum return thresholds or minimum deal structure considerations around what sort of a de-SPAC or direct listing could result in an auto convert. We've already talked about convertible preferred as being senior to common equity, and that's senior in the sense of liquidation preference, but it is still junior to debt and any senior preferred that you may have. And as I mentioned, this is the most frequent capital raise security. Laurel, one question for you on this. Why do you think it is that this is such a sweet spot for investors and companies from a structure perspective?
Yeah, I mean, I think it's all about risk. So when you think about if there's more risks to the company that they'll be successful or maybe that they'll be able to grow as quickly, when you have a liquidation preference to the extent that the company isn't successful and you are sitting senior to other series of stock, then if there were a liquidation scenario, you would get your money back plus your liquidation preference before others in the capital stack after debt. So I think this is one way that is very well known, as you said. People are used to issuing preferred equity. It's understood in the market. Investors understand it. Companies understand it. And the liquidation feature in particular is one I think that gives investors comfort. One thing I have noticed in the market, I would say over the last couple of years, there was a lot of pari passu that was happening, which was surprising to me. So 5 years ago, there was always 1x liquidation. And then there was this time period of pari passu everything, which seems odd to me because there's potentially, maybe more risk if my dollars are going in later, again, on execution or whatever risk I think there is, commensurate with that security. But the market was dictating that most of the deals that were getting done were pari passu. So everybody was on the same liquidation preference. Nobody was senior to anybody else. Now I think we're seeing 1x liquidation senior preference to the new money in or most recent money in. So again, these are all market driven and what the company and the investor can negotiate.
And Courtney, do you see benefits in the market from a negotiation perspective of using this structure?
Definitely. Given how common it is, as you both have noted, it's a highly efficient and mature market. The market terms are well understood, and you can consult with whether it's a law firm or an investment bank to learn what the market terms are, which obviously is helpful in any transaction. Each transaction has its nuances, but it's pretty easy, given how sophisticated and mature this market is, to understand what the market terms are at any given time.
Moving on to some of the benefits and drawbacks of this structure from both an issuer and an investor perspective. So from an issuer perspective, like common equity, there's no maturity date unless the investor has a redemption right. So what is a redemption right? This would be a contractual right to have the company pay you back some dollar amount on your equity at a fixed point in time. So frequent time period would be 5 years. 5 years post-investment, the company has to come up with the cash to give me at least a 1x return. Sometimes you can have a multiple redemption right. It's less common. But assuming no redemption right, then you have no maturity date. Some drawbacks from an issuer perspective: you got to give customary minority protections for investors, which means you're going to lose some control. Some of these things that you'll typically have to give are sale limitations. So you won't be able to sell the company without preferred holder consent. You'll have to give a board seat or two. You'll have to give a block on future equity raises because if you come in as a preferred equity, one of the things that you're going to focus on is, can the company bring somebody else in that's more senior to me that can get their money out first? That can happen through a debt raise. That could happen through a new senior equity raise. And so typically you're going to have to give, if you're the company, you're going to have to give a block right on senior equity raises and sometimes pari passu equity raises. Laurel, you mentioned that. So pari passu meaning somebody that invests and is on equal footing with you from a liquidation perspective. So everybody would share their liquidation preference on a what I would call a heads up basis based on the number of shares you hold. A lot of times investors will want a block right on those equity raises too, because it dilutes the value of your liquidation preference. And then a block right on debt. Obviously, debt's structurally senior to equity, and an equity investor is going to be focused on making sure that they at least have some say over debt coming in. Now, companies are very hesitant to give that, at least in my experience. They're hesitant to give that block right on debt especially at the equity holder level. And that's because if you have a block right on senior equity financing, if you have a block right on debt, you basically have a veto right on any new capital coming into this business, because while a company could theoretically go raise financing that is junior to you, so it's either a junior preferred or common equity, it's really tough to get that done in the market. And there aren't a lot of investors out there who would be willing to put new money in at presumably a higher valuation and be junior to investors that are already on the cap table. And so functionally, these two things combined give the preferred holders that have this right a block on future financings. And that's really difficult for a lot of companies to stomach. Although, in my experience, it's typically where you end up. One of the things that companies will do to try to minimize or at least put some guardrails around the risk that you have a bad actor investor that for some reason says, I'm just going to block all financings, they will try to move the block right over debt raises from an equity holder level protection to a board level protection if you're an investor that has a designee on the board. And the benefit of doing that from the company's perspective is that that designee on the board is going to owe fiduciary duties to the corporation as a whole. And if it has a block right at the board level, meaning you need that director to approve the debt financing, then it's going to have to exercise that discretion with its fiduciary duties in mind. And so if it's in the best interest of the company to go raise the debt, from a fiduciary duty perspective, they've got to approve the transaction. So that's one thing that you'll see to try and soften that up a little bit. So from an investor perspective, some of the key benefits, as Laurel mentioned, downside protection is huge for investors, knowing that you're going to get your money out before common equity. But the other great thing about this convertible preferred structure is you have the upside of a common equity investment, and you may have paid a little bit more for the security than you could have if you bought common equity, because you have this downside protection. But subject to whatever that discount was, you get to participate fully on the upside. You also get all of these minority protections, some of which we've talked about. One of the drawbacks, though, similar to common equity, is you've still got this liquidity issue. How am I going to actually monetize this investment? Which, at the end of the day, is what an investor wants to do, is get a return on their investment. And similar to common equity, the typical ways that you would do this, other than selling your stock to a third party, are things that are going to be outside of your control. So it's things like selling the company or IPOing. So you got to think about how do we want to get out, when do we need to get out, and what sort of contractual protections can we put in place to make sure that we're comfortable on that. We'll talk a little bit more about that on the next slide. Another downside is you bought in at a fixed price. You put a mark on value of the common, as I talked about earlier. Your conversion price, the price you paid, is what you're more or less valuing the common stock at. So if a new investor comes in later at a lower price, you don't, unless you have anti-dilution protection, you don't really get the benefit of that. So another thing to keep in mind there. Then you have other investors that will treat it with a much lighter touch. And they may come in and focus on some basic financial diligence. They may do some cap table diligence. They may do some limited diligence on the IP. And I put on the slides, if we get there, this is sort of, it's not exactly buying a lottery ticket, but the further you go down the light diligence path, the more it becomes like buying a lottery ticket. Last point on convertible preferred. So there are some great resources out there that help these deals get done really efficiently. One of those is the NVCA model documents. You can go to the NVCA, which is the National Venture Capital Association. You can go to their website, download these documents. It has a relatively market set of terms. It's got annotations on why would investors or companies want these things. Super helpful. Really helps in most deals if you use these forms. It helps get to a deal faster. It helps get rid of extraneous friction, which is always music to clients' ears, at least my clients. Next structure we'll talk about is convertible notes and safes. Okay, I think we're safe. No pun intended. Thank you for laughing at that. So convertible notes and safes. The way to think about this general structure, and there are multiple ways to structure this investment type, but the way to think about this is it is a security that isn't putting a mark on the common equity today. It's delaying that until some future financing event. So I put, again, $10 million into a company. At some point, contractually negotiated, that $10 million is going to convert into an equity interest in that company. But at what price is to be determined? And that to be determined, typically, it's going to be whatever the next major investor, quote unquote, that finances this company is willing to pay. So benefit to the company is if you believe that your company is growing and the value is going up, delaying that valuation event means that this is cheaper capital than it otherwise would be if you had to put a valuation on the business today. One of the other key economic points of these securities is that, so take what I just said and think about it from an investor's perspective. Wait a minute, I'm putting money in today, but then I'm going to pay the same price as somebody who comes in after me, after my money came in, and presumably after the business has developed a little bit. Why should that be the case? And so one of the other features that you'll typically see here is some sort of a discount to that valuation, like a 20% discount or a 30% discount, or a cap on what that valuation may be for your conversion price. So if somebody is willing to pay $800 million as a valuation to buy into an equity round, you may have a conversion cap of $400 million. Very good deal economically. Typically, you see these securities in bridge financing. So if you're raising some money in anticipation of a larger raise, or in special deals. And as I mentioned, you got lots of flexibility here. So on flexibility, and I'm just going to handle this at a pretty high level. So you'll see these structured as convertible notes. So that's structured like debt, which means you're structurally senior to all the equity. That's great if you're an investor. If you structure these as a convertible note, there's also going to be a maturity date. That's also great for an investor. There's a fixed moment in time where if the company hasn't raised money, hasn't done something that would create a conversion event, then they've got to pay you back your capital plus interest. That's another important piece of these convertible notes is there's a ticking return element and interest component. Another way to structure these, though, is with what's called a SAFE, which many of you may have heard about. A SAFE is really just a contract that says, if you invest money in the company promises to give you equity at some point in the future, whenever the SAFE says you will. And so that's not debt structurally, or at least most practitioners don't think of it as debt. But it functions more or less like convertible preferred equity from a seniority perspective. And so more like equity than a convertible note. And the other key benefit for a company is that it doesn't have a fixed maturity date. So that SAFE just sits out, typically will just sit out there for as long as you need until you, as a company, are ready to raise additional capital. Perfect. So just one last thing, because I want to make sure we get to the end. What happens if the maturity date comes, or if the company sells before this convertible note or SAFE has converted to equity? That's a pretty bad result for the investor if what the note says is the company just gets to pay back your principal plus interest, and the interest is something typically like 8%. It's not a huge amount of interest. Because if you're an investor investing in this instrument, you're expecting an equity-like return, not a debt-like return for the most part. So that's where premium payments come in. You'll frequently see issuers require that if the company gets sold before I convert to equity, you don't get to just pay me back my principal plus interest. You've also got to give me some sort of a premium, whether that's 1x, 2x, the principal amount of the note, some multiple return to make sure that the juice is worth the squeeze. Next slide. So quickly going through the last two structures so we can get to some of the trends we're seeing. Redeemable preferred, think about this as preferred stock with none of the upside that convertible preferred gives you. This is preferred that just has a fixed coupon, cash pay, looks like debt economically from that perspective, but it is equity. So the company has to pay you back your invested capital or principal plus some fixed current cash pay coupon. You do sometimes see penny warrants in these deals. I mean, especially if you're doing these deals for a private company, because the investor is going to want some upside. So you can do that through penny warrants. Next slide. And just quickly, it's some of the key benefits from an issuer perspective. If you could raise a redeemable preferred at a good price, that'd be excellent because you're not suffering that equity dilution. Again, there's none of the upsides getting captured by the preferred unless you're giving penny warrants. But there's a fixed maturity date, and you've got to come out of pocket and pay a cash coupon. From an investor perspective, again, current cash pay is great. You're also structurally senior to all the other equity, but you don't have that upside unless you can get penny warrants. Next slide. As I mentioned, you don't see this as frequently, but wanted to cover it quickly because you will every now and then. Next slide. So debt, again, don't need to spend a ton of time on this. I'm sure most of you are familiar with a typical first lien secured credit facility. That's really what we're talking about here. Similar return profile to a redeemable preferred. You invest a fixed amount of capital. It is accruing some coupon or interest rate. Some of that may be picked, but ultimately you're going to get that value. You're sitting at the top of the capital stack. You may even have a secured interest in this company to the extent that it has things that you would want a security interest in. And again, you can capture some of the upside via warrants, which can be penny warrants if you want to do that. And from a company perspective, going back to cost of capital analysis, if you can raise capital in this way, pay a fixed coupon, and give some limited warrant coverage on the upside, then if your business continues to grow and get more valuable, this is going to be a much better outcome for the equity holders long term. So that should take us to the last thing that I wanted to cover, which is a quick discussion on some market trends. And you can go to the second to last slide. And I had a few questions for Laurel and Courtney on this. So we talked about valuations are dropping because of the public markets. We haven't talked as much about the IPO market, but the IPO market, if anybody follows that, is historically bad right now. Very few companies are doing IPOs. SPACs have become much less active. What does all this mean, Laurel, for what we're going to see in the next year or two in the market?
Well, I mean, I think as an investor, every time the valuations go down, I think it's a good time to be an investor because you might be able to be negotiating more favorable terms than you otherwise could when the market is hot and the deals are very competitive. I think it allows investors to protect downside risks to get the protections that we've talked about. But also it's in previous downturns in my career, it's been a time when certain companies don't survive. And then the companies that are the strongest to sort of weather those downturns are actually end up becoming sort of the most enduring companies. They've pivoted, they've understood what the market wants, have a clear path to acquiring their customers, sort of when they have to retool, maybe even have a RIF. So I'm not saying that's going to happen in the next couple of years, but I always find it interesting in various, market cycles that I've been through as an investor. If I currently have a portfolio company, really thinking about what the cost burn is, when the company is going to be able to raise again from an investor perspective, if I've already made an investment. And as an investor who's waiting to make an investment, then I get to see how terms are shaking out among lead investors, who's circling around the table, who has cash to deploy. And I think it's an opportunity.
Courtney, what about your perspective on where the market's going?
So first and foremost, I would say that investment in energy transition is going to continue to be strong for all of the reasons I outlined earlier. Just massive tailwinds in the sector overall. You see a lot of companies accessing the market to strengthen their balance sheet, given the level of uncertainty in the market, and I expect that to continue. And one thing we talked a lot about kind of terms and things, but one dynamic that we've seen and I would expect to continue is a meaningful shift in the approach to valuation. In the last several years, to Laurel's point, a lot of these companies are very early stage and investors were giving credit for further out metrics, whether it was revenue out 5-8 years, discounted back to today, giving companies credit for that performance today. We've seen a massive pullback in that. Investors are increasingly looking at more near-term metrics. They're really validating the financial model, the near-term financial model. And the last thing I'd say is that there's more of a focus on spending and pathway to profitability. Most of these companies are not profitable today, but investors increasingly are looking more to pathway to profitability as opposed to a year ago when that was less of a focus.
Well, excellent. Thank you both.